Good morning, everybody. It is December 4th, Friday. It's a Friday in December, and it's about 30 degrees in Milwaukee. Curious to know how many people are warmer and how many people are colder. And if you're warmer, I'd like to know where that is so I can go and, just kind of drive down there in my car and over there in my car and stay inside the car because, everybody's got coronavirus now. In any case, I had a very eventful morning. I bought a treadmill. I don't know what just happened. Oh, yeah. Bought a treadmill. So the next time, maybe not next time, but in a couple of shows, maybe I'll be in the basement and I will be treadmilling while I talk to you. Now, the interesting thing about what's going to happen at the end of December, probably the second to last Friday, we will have a chart book every single Friday that you can access via the services, whether that's margin of safety investing or fundamental trends. And I would just point out one of the things we are going to talk about today is some utilities because Dividend Sleuth did a little article on utilities, and I hope that you're all reading his stuff. He's agreed to write something every week now. Looks like he's ready to go. Hopefully his family situation allows him to do that, but he writes some good stuff for retirees. He's a retired gentleman, broad range of experience, one of our two analysts, and I am actually still looking at a third. The other guy, Dave Zanoni, him and I don't see eye to eye on everything, but he tends to be pretty on the money when he says it's about time to buy something. And he follows, some of your bigger growth stories. He's taken a look at McDonald's, and I haven't taken a look at the price analysis, but between what he's written here, and then if you take a look at the SWOT analysis, which just outlines the strengths and weaknesses and opportunities and threats for McDonald's, you see that these little theses that we have, the bullet points, really help with developing an actual thesis. And I think that you really benefit from reading these SWOT reports anytime there's a company that you're interested in. We focus on writing based on what's in the plug and play that quarter. So generally you'll get something there. And then we also go to the rest of the very short list as well, which I have added a couple stocks to recently. One of them was Viva Systems and Health, and Delta came off the suspended list a while ago. I'll leave that as new. It's not really new. We liked it, then the coronavirus hit, so we took it off. General Electric is still on suspension. I still think that General Electric is at risk of going bankrupt, but ironically, the CARES Act helped them a lot. So maybe not. Maybe I should take them off the suspended list, but I haven't had time to look at them. I'm not terribly interested in their growth story or their dividend, so not a lot of hurry on that one. Great Lakes Dredge and Dock was on the last quarter's plug and play. It's not right now because we don't know that we're going to get that big infrastructure bill anymore. Advanced Drainage Systems, MP Materials. I think that you should keep an eye on this one. I think it's going to end up being a $10 billion company pretty quick. And then we added, on the utility side, we added American Electric Power, which is a company I'd already been studying for quite a while because they're big in transmission. And one of our subscribers actually pointed out, hey, I've really been looking at American Electric Power. What do you think? And I said, hey, I'm already looking at it. So it's added to the list. It's not a priority pick by any means, but it's one of the companies that I think that you can take a look at and say, well, on pullbacks, might be something to take a look at. And you'll notice that a lot of the utilities in the last 4 weeks have drifted down. We have these snap charts in our watch list. So it's pretty interesting, some of the opportunities that are coming up. So I think that these utilities, on any correction for a dividend investor, are going to be pretty important to get involved with. Same thing with some of the REITs that we've been covering. Have added a couple of REITs. And, my general thesis with REITs is that we want to be very careful not to invest in companies that are in what are likely to be permanently different businesses. And what I mean by that is somebody asked me about rental community REITs. right? So do we want to buy apartment REITs? And I don't think the answer is yes. I think the answer is no for a couple of reasons. The pressure on apartments is going to be lower in the future than it has been in the past, until at least there's a massive wave of immigration. But even then, we don't really know if the rents are going to hold up. We've seen rents come down almost everywhere in the country. And it's going to take years and years and years for those rents to get back to where they were. In the meantime, most of these companies have higher debt now. Even though that debt is cheap, it's still more debt with lower rents. And where we're bullish in real estate really is in building and in services. So we probably would expect a lot of homes to be built in the 2020s because there's a shortage of single family homes. There has been for about 10 years. And I think that the companies that we focused on, like Pulte and NVR and some of the service companies, are really the place to actually make a lot more money. And as attractive as some of these yields seem, I mean, seriously, 20% yield, does anybody think that that's realistic? And even a 10% yield for Tangier, there's no way that's realistic, right? So, you take a look at some of these dividends, and you have to ask yourself, to what extent is this telling you that the risk is just really high? In general, that's what it's telling you. When a dividend is significantly above its peer group, it's telling you, the market is telling you, there's a lot of risk here. So you better try to figure out how to appreciate that risk. The mortgage REITs, of course, are leveraged. So that's why their dividends are so high. And you should ask yourself, in the coming environment, will they be able to continue to maintain these dividends? And I think it's uncertain at best, and they certainly won't have any growth. But I think that you're going, because the new mortgages will be even lower interest rates than the old mortgages. You have to ask yourself the question: they're using leverage to get this yield, and what happens if interest rates do tick up a bit, or more importantly, liquidity tightens up a bit? The idea that we can print money forever, and again, I explain, you say printing money, but quantitative easing isn't really printing money because on the back end there's debt. Printing money would be no debt attached. So the quantitative easing at some point on the front end, right, is stimulative, but on the back end is deflationary. Why? Because you got to pay the debt. Unless you monetize the debt, in which case you hurt the dollar even more. So we will talk about the dollar at some point. I bet you didn't think I'd get to my main points, but I wanted to end with dollar. So I do think about these before I go on air. But I don't want people to get super excited about all the REIT cheerleaders that you find in the press, because a lot of these REITs are permanently damaged. They're going to struggle, as I've shown you, they're going to struggle to beat the S&P 500. And if you're going to take single stock risk, which these are stocks, they're structured a little different, but they're stocks. You have to ask yourself, if I can't really beat the S&P 500, do I really want to take single stock risk? And our whole thesis is that no, you don't. So you're going to see several of these come off the list for the first quarter, because I'm really tightening up our risk parameters for the next couple of years. And that's in light of different ways of thinking based on what happens with the Georgia elections. I think if the Georgia elections keep the Republicans in control of the Senate, you're going to have very little getting done in the next 2 to 4 years. So that would mean that we are purely relying on market forces and the Federal Reserve, because the Federal Reserve will be the only game in town for stimulus, which takes us to one of our investments that we'll talk about. So in any case, I hope that you are reading all of these. I have several of these that I have to put up on fundamental trends yet. I have been updating the chart links. I just wanted to point out that a lot of the money that we put into the system through the CARES Act went to a lot of places that it didn't belong. And I'm pointing this out, and they're not the only ones that are guilty. So the Washington Post points out that you had all kinds of gigantic corporations. It wasn't just Trump and Kushner. It was all sorts of gigantic corporations that took PPP money that was intended to help small and medium-sized business. You'll recall that I told you that last week, one of the programs that we had already said wasn't working, that was taken away from the small companies, was the Main Street Lending Program. So not only did small and medium companies not get this money, but then they had the Main Street programs taken away. And that's why a quarter of all small businesses are out of business now. And probably it's going to top out at somewhere between 40 and 50% of all small businesses are wiped out by the pandemic because government didn't help them. Government helped big business, but not small business. So that tells you two things. One, a lot of the big businesses are overvalued because that small business competition will come back. There's a lot of entrepreneurs out there that are regrouping, a lot of small business owners who are thinking about what they went through and taking, most of them actually had money on the side, but in small business, you are supposed to pay yourself first. So the small business owners who did things right, they didn't go broke. Their company went under, but they personally still have a pile of cash. They're going to come back and they're going to start new small businesses that'll be better than the ones before. And you're going to see a wave of small business entrepreneurship here in the next 5 to 10 years that I think you're going to be surprised by. And right now, they're getting great deals on real estate. So next year, when they finally start to get really ramped up, again, presuming the pandemic is almost over sometime next year because of a vaccine. And at this point, we got to be well on our way to herd immunity through infections. I think that, and we're not positive about that we're going to get herd immunity through infections, but it seems like after about 6 or 7 months, your body is kind of like a donut hole. You're short-term immune, and then you're at risk again, but then your body kicks something else in through the T cells, and you're basically very low risk. So you go from essentially immune on coronavirus to at risk again to very low risk. It's weird how it works, but the current research is showing that it's kind of a wave, from immune to vulnerable to almost immune again after you've had it. The economy should recover at some point next year. It won't be fast because business formation takes time. People have to get their jobs back. We still have a ton of people unemployed, and that's where we're going to go to next is the unemployment numbers. And when the economy gets going, you're going to see pressure on the big guys from the little guys again, because the little guys, the restarts, the ones that just wiped out their debt and walked away from a business and now they're going to go back and improve upon it. The boomers are mostly staying retired. That doesn't mean they won't invest in their nephew or their cousin's kid or their own kid or somebody in the neighborhood or somebody who bought their business and maybe they take an equity stake to help them get started. There's going to be a lot of good small businesses to start in the next couple of years. I saw this happen in 2010 and 11. Is the people who started in 2009, 10, 11 really ended up doing well. I got a buddy who started a trucking company and he's making buku bucks. And especially with the way the economy has gone, he's doing all right. But you take a look at companies that came out of the last big washout and they came in stronger and very competitive. And you saw a lot of rejuvenated areas, which are very beat down right now. There's a huge selectivity though, because businesses that died in areas that people didn't really want to be in the first place, but they're kind of locked in because of pricing of their real estate and things like that. If they reopen, they're not going to reopen in the same spots usually. They're going to go to the areas that they think are going to be the best for them. So there's going to be even more bifurcation in the economy that we've seen from the top down, and now it's going to happen from the bottom up. So the losers will be bigger losers, the winners will be bigger winners, and you're going to see small business, micro caps in particular, I'm really interested in. So we're going to see several micro caps get added to our watch list because some of these companies, these 50 and 100 million with an M, 50 and $100 million companies, they really are in a good position right now because they survive. And a lot of them, because they don't play the debt games that the big guys do, they're cash rich companies that are growing. And now in their area where they operate, and a lot of them are regional or just in a city or a metropolitan area or a certain state, they're going to really be able to take over some of those markets. So even though a lot of the PPP money went to big companies and people that shouldn't have got it, the washout, this is the part of the Austrian economic view that's correct, is that when an economic cycle ends and washes out the weak, you end up with strong new competition. So we're going to need to be looking at micro caps and large caps versus large caps in a very new way, I think. And we have to stick with our barbell, right? We want to be in tech, an industry that uses tech and the right services and the right consumer plays. We want to stay away from a lot of that stuff in the middle. And then we get to the other side of the barbell and you have your resources and your real estate, your alternative investments, maybe Bitcoin, things like that. So we got an economic report this morning and the market went up because, oh, bad news is good news. It doesn't matter. Bad news would have been good news. Good news would have been good news. No news would have been good news. Doesn't matter. Stock market just goes up. And it doesn't make any sense based on valuations, but liquidity is easy and leverage on leverage pumps up prices, just the way it is. It'll end eventually, hard to know when. So in any case, the jobs numbers came in weaker than expected. Payrolls rose by 245,000. The expectations were for over 400,000. So hiring got weaker. But some of the numbers that I thought were interesting, I'll just rattle these off the top of my head. I'm not going to go through every link that I have, is that the number of people working from home rose again. And right now, over 1 in 5 people work from home. It's about 22.8%. And I think it's a little higher than that because it just doesn't really, a lot of the self-employed and the gig workers, they don't really account for. So I think you see fully about a third of folks are working from home right now. And of those folks who work for a company, which is what that 22.8% represents, a lot of those companies are saying, look, you're going to work from home through next summer. It's pretty much what they're saying. Some of them are saying through the end of next year already. And a lot of them are saying, you're probably going to work from home permanently and you're going to come into the office here and there. Think about the impact that has on just so many things. Restaurants, oil, what types of services get used for dry cleaning, how many clothes get bought. You know, it really changes the dynamic of how people operate. Now, I've been working from home since January of 2016. That's when I decided to close my expensive office, and I decided to work from home and be extremely selective on clients that I took. And, you know, at this point, I only take clients who read my work. I won't take somebody who just finds me on the internet. If they haven't read my work and say, hey, I've been reading your work for a while, and this is what I think we're on the same page, I won't take the case. So I think a lot of people are going to find their niche the way I have, and that's going to keep them working from home because people want to work from home. Now, do I want to get out once in a while? Sure. Do I like going to lunches? For sure, at least once or twice a week if I can. Right now I can't. Breakfasts, I mean, I always like going out for breakfast. So, you know, meet with my farmers, meet with the guy from a couple of companies, guys from a couple of companies that I invested in, other investment guys, you know, go see my favorite waitress, a nice 60-year-old woman who, you know, always made sure that my coffee was waiting for me. And, you know, I think these routines of life are going to change and buying behavior is going to change. And a lot of the things that you're seeing right now that you think, oh, this will all go back the way it was, it's not. This is permanent, the way that we live now. And while it will be a hybrid as the pandemic ends, a lot of things aren't going to change. I think takeout is going to become more popular. I think prepared meal kits are going to finally take off. You know, you're talking about that for a decade. There's a lot of things that are going to change. And the small business entrepreneur, I was watching Mr. Wonderful in a webinar through Benzinga. He was saying, look, here's how the restaurants of the future are going to work. They're basically going to be a central kitchen to serve a neighborhood, and they'll have a little bit of seating, probably a lot of it outdoors or covered or something with the garage doors that open, you know, to the street. But you're going to have a really good kitchen and a really good pickup and a really good delivery. So all these things are changing right now. We went to a restaurant the other night. Was it last night or 2 nights ago? I don't even remember anymore. I think it might have been last night. And we went to an Italian restaurant not too far from our house, about 5 miles, because we had picked something up and we were hungry and I didn't want to cook dinner last night. So I went to an Italian restaurant thinking, well, they say they're serving. We went there. There's only 4 people in the restaurant and there's like 8 people in the bar. Can't stop people from sitting next to each other at a bar because, they need what they need. So we went there. It was a great meal. But I asked, I said, how's business? They go, oh, it's probably down about 50% from last year. I was like, whoa. And I wasn't really sure how they keep the lights on. And then I looked back over into the bar. So, I think a lot of these businesses are going to adjust. I'm not so sure if this one will, because the owner said he didn't want to invest in the systems, the website and the ordering to do takeout. Well, I tell you what, the food is good and they have good reviews. The fact that he's not pushing takeout and not offering delivery, and I can see why you wouldn't offer delivery, but you got DoorDash now, right? You don't have to take the liability. Why he didn't spend about $3,000 to upgrade his internet and ordering systems and give his cook and his waitress iPads, I have no idea. Because that I guess with the iPads, $4,000 investment, because I know how much these websites and systems cost, well, it's a couple $100 a month. He's costing himself tens of thousands of dollars. And if he goes under, it's because he didn't run the business right. Because that's a business that has good food and he could sell it if he could just get people to order it online. There's a little Thai restaurant not far from me, and they were just opening when the pandemic hit. And he immediately took him 2 weeks. He immediately pivoted. He invested money right away to make sure that you could order on the website. He got hooked up with DoorDash or maybe the other one, I forget what it is, Uber Eats. And, he actually puts on his Facebook and on his website at about 2 or 3 in the afternoon, hey, if you want to order for tonight, we're booked out until 7:15 already. And then he updates it and it just tells you where the slots are. And he slots it every 10 minutes, I think it is. So there's a way to run these businesses that'll be very efficient using technology. Same thing goes to industry. We saw that PTC, a company that I was talking about a long time ago, has gone through the roof this year because of automation. There's a lot of things that are going to change. And I think that you're going to see small businesses and microcaps really thrive. I think entrepreneurs are going to have a huge opportunity. And the large caps, because they're so overvalued right now, their growth is going to slow. Their earnings are going to flatten out after they rebound. And you're going to see a whole change in outlook on what is going to be a good investment versus what was a good investment. There's a paradigm shift coming, and we're in the middle of it right now. And because we're in the middle, I don't know that we really appreciate it. So if we go back to unemployment, what we're seeing is that the labor participation rate is falling. That's why the unemployment rate fell. So it's not that the unemployment rate is really 6% or 6.7%. When you put in the gig workers and self-employed who are out of work, all those people on PUA, right, the pandemic unemployment assistance, that's going to expire at the end of this year if they don't extend it, that means that unemployment is really somewhere in the teens because the number is much higher when you count them. So between the labor participation rate falling, because the boomers, and we talked about this 6 months ago, the boomers who go out of business or lose their jobs, they're not going back to work. They're retired. So they were forced in retirement. They're collecting as much unemployment as they can until they have to kick in Social Security and pensions, start taking money from their 401ks. That wave of uninvestment, right, of outflows from the market is going to continue. And it's going to get bigger and bigger and bigger. So what do? We got to hope that the millennials make enough money to offset them. And in the meantime, Federal Reserve. So we have to think about, with everything that's changing in labor, the generational things, the technology things, how manufacturing coming over here really doesn't matter that much because it's just done by robots. And the people who actually get manufacturing jobs are engineers of some sort, or at least they can do tool and die and CDC and things like that. They're not unskilled, right? So the unskilled worker's in big trouble. It's just going to get worse and worse and worse for them. So, I mean, you should tell your high school kid to come here and listen to this right now, mark this minute, If you're a high school kid, you're not thinking it's that important to get an education, you're wrong. Now, I'm not saying don't go into skilled trades. We need a lot of skilled trades. And, the people who helped me build the room for my daughter's salon, he was telling me, look, you would have spent $2,500 to build this room. It was 2 walls. Why? Because those guys were getting $120 an hour to do basic carpentry work. At least that's what the contractor gets. And then the people that he hires are still making, 40 at a minimum per hour, but a lot of them are making 60 or 80. So this idea that you can't make 40, 60, $80 an hour with a high school education and then maybe 2 years in a tech school or an apprenticeship program is wrong. The problem is we always have about 1 in 5 people who don't want to work that hard. That 1 in 5 people are going to be the challenge forever. They've been the challenge. They're going to continue to be the challenge. How do we convince those people that don't want to go to college and get a tech degree or something that understands information technology or medicine or something that's specialized to the point where there's demand, right? How do we convince people who don't want to go to college, which is like half the population, to learn a skill that'll make them money, right? Or do the dirty jobs, right? There's a whole show on dirty jobs. All this is coming into play right now. And that's what's going to change the world in a lot of ways, but it's also going to change the political outlook. If not enough people get employed gainfully, we're going to keep getting stupid pushes for socialism. And we're going to keep getting stupid pushes for modern monetary theory, things that will destroy the dollar. And what do we know about the dollar? Anytime there's a dollar that gets really beat up, we have a financial crisis. We are flirting with that next leg down right now. And if it happens, there will be a financial crisis. So let's take a look at debt and then we'll work our way to the dollar. This is the federal debt as a percentage of GDP, 127%. Now, this chart doesn't go all the way back to World War II, but if it did, this is about where World War II is. So we are now carrying more debt as a percentage of GDP than we did during World War II. See, we were flirting with it all in these years, and now we're past it. We are carrying the most debt we've ever carried. Who owns it? Now, this is the old chart, right? This is a couple of years ago. I just grabbed one, but it's about right. U.S. investors, about $7 trillion. Foreign investors are about in the 6s. U.S. government owns its own debt, Social Security, things like that. Then Federal Reserve, and this is up to about $6 trillion. So you'll see the expanding part of who owns the national debt is the Federal Reserve. They do this through the banking system. And the idea that I think you need to wrap your head around is someday the Federal Reserve is going to need to be bailed out. I don't know when that'll happen. There was a report out in the last week that I put in the chat room, and Teresa will have the chat highlights hopefully today. So I'm going to work on it tonight. And I have her chat notes from last week, so I'll incorporate those. But we have chat notes, and one of the things that's in there is a link to a study or an article with a link to a study that in 2028 is when all these headwinds come to, run into each other. Social Security runs into a problem. Medicare runs into a problem. The Federal Reserve is probably $10 trillion in debt by then, at least maybe 15 trillion. And the state and municipal pensions, which are about $6 trillion underfunded right now, will probably be 10 trillion underfunded by then, because they invest in bonds, which have low interest rates, and large cap stocks, so they think that they're less risky, and they're not. And those pensions are just going to be toast. So in other calls, I've talked to you about what we need to do to bail out everything right now and just have a reset so that we can move forward. If we truly printed 15 to 20 trillion dollars right now, basically an entire economy, and we wiped out most of the Federal Reserve debt, and we funded the 6 trillion in pensions, and there's another 5 or 6 trillion that should go to Social Security to buy U.S. government debt, and then a few trillion for projects like infrastructure. If we bailed out today all the things that need bailed out and did an infrastructure program, cost between 15 and 20 trillion, probably closer to 20 trillion. If we wait a decade, that number at least doubles, and it might triple. You're talking 40, 50 trillion dollars is going to be the required bailout in about a decade. What if the economy doesn't grow very fast between now and then? Right now, we have federal receipts as a percent of domestic product. Let me see here. And what this represents is about how much money the government collects out of the economy in taxes. And the number has always been between about 15 and 20%. So when they argue about corporate income tax rates, should it be 21 or 25 or 28? The answer is actually 21. Corporate tax rates right now are right. People bitch and moan about that. Oh, the corporations aren't paying their fair share, and they're not. But it's not because the tax rate is wrong. It's because every freaking industry out there is lobbied for some sort of loophole or tax break or structural thing that lets them pretend to have their company in Ireland or the Cayman Islands so they don't have to pay U.S. taxes. I mean, why can Google or Apple or any of these, big time tech companies, why can they say they really are, they're out of the Cayman Islands or Ireland for tax purposes, but 70% of their business is in the U.S. When companies like Amazon and Google and Apple and Facebook have real tax rates of 2, 3, 4%, but then they brag to their shareholders about how much money they're making to drive the share price up in a liquidity-driven market, something's fucked up. And again, I got yelled at for saying fucked up a while back, and I thought about it, but I think it really makes the point. The corporations aren't paying their fair share. The big ones aren't paying their fair share. The bigger you get, the less of your fair share you're paying. So your S&P 500 companies in general aren't paying their fair share. If they just paid between 15 and 20% net based on a 21% tax rate, got rid of all the loopholes, which is actually Joe Biden's big thing, then we'd be doing much better. And what we find is that when total collections are pushing 20%, we do really well. How well? Pretty well. Did you notice what year that was? Where collections were about 20% of GDP? At the end of the 1990s, we started running a surplus, and then we had tax cuts. And in the last 30 years, it was a pretty predictable cycle. And it actually started right here. That was Ronald Reagan. But then George W. Bush actually raised the taxes, and he got voted out for it. So the oil deal coming off the gold standard, right? And the OPEC, withholding oil from the United States, a lot of things conspired from about 1970-ish to about 1991-ish to drive the U.S. economy into deficit spending. Bill Clinton tried to bring it back. George W. Bush ran huge deficits, so we got the financial crisis. Barack Obama started to bring it back, and Donald Trump started to bring it back down. As I told you a year ago in my forecast, and this was before coronavirus, I said, look, we're starting to head towards another financial crisis. It might take a few years, but because we're doing this, we're lowering, it's important for you to really truly understand this stuff. Because we're lowering the amount of revenue that the government gets, it's bad for the economy, it drives up debt, and ultimately it leads to a collapse in the dollar and a financial crisis. I'm not sure if we can avoid a financial crisis this decade. I'm pretty sure that we can't, but I'm not sure when it'll happen. If I had to guess, I'd say end of the decade sometime. And I've been saying that for 4 or 5 years now, since the end of the Obama administration. It's not hard to look at these charts and overlay them with events and with the stock market and do a study and realize we need receipts close to 20%, and we can survive on that. We can actually do everything that we want to do and then some. At this number, we could pay down our debt, we could do infrastructure, we could have cheap college for everybody. There's so much we could do if we just have right around 19-20% in revenues of GDP. But right now, and tax rates aren't going to go up in the next 4 years, I don't think, unless the Democrats get the Senate. But I'm not even sure all the Democrats will vote for it. In 2009, they didn't vote for tax increases. They didn't get tax increases for 4 years, because they delayed them because of the crisis. They'd probably do that again. I would bet that even if the Democrats win the Senate, that we may not see higher tax rates. We just might see them get rid of the business loopholes because that's hidden to some extent, right? They don't raise any of the tax rates. Nobody can run against them because of that. You get rid of the loopholes on corporations, you maybe raise another 1 or 2%. It's still not enough. Still deficit spending. Still heading down into the debt abyss. And ultimately, damaging the dollar. This is a chart that we keep coming back to that I want you to really pay attention to. All that deficit spending I just showed you under George W. Bush crushed the dollar. We had a financial crisis. Took some time to stabilize it under Obama, and then it went back up into what I have called the Goldilocks zone. Gets up here, they let it weaken. Gets down here, they try to strengthen it. And I think they're going to do it again because they know what I'm showing you is that if the dollar falls below about this line, you get into a danger zone. And there's huge support for the dollar in here that we'll probably start to see. If I add that line back in where the buying is, you can see there's pretty significant buying for the dollar right at the level that we're getting to. And then there's another big level of support down here. So the question is, does it jitterbug here and then start to drift up? And if it does, what does that do to the stock market? In the short term, it's bad. Long term, it's good. It's a lot like a lot of things that are better in the short term and worse in the long term, or vice versa. If it gets all the way down to here, which it might, especially if the Fed is the only game in town, then you start to see certain investments do better than others. And if I had to guess, I would say they will do a fiscal stimulus package. It's going to be a little under $1 trillion. About half of that money is from the old bill. So it'll only be about $500 billion in new money. I think they're going to give folks $200 or $300 extra a week on their unemployment. I think they'll extend the unemployment to March 31st. They should extend it to June 30th, even if the last 3 months you don't get any extra money, because to bring all these jobs back is going to take time because the entrepreneurs need time to open their businesses and remodel their real estate and get their systems in place, then hire people and train them, and then they open. That process hasn't really started just yet because people are like, we think the economy is going to start opening up next summer, but what if these mRNA vaccines are more dangerous than we thought? And I think that they will be. They cause chronic inflammation is what one of the side effects are. Chronic inflammation is like one of the worst things you can have. It's painful. Now, they're giving it to elderly people. I think that we have a surprising lack of empathy for them. So we'll rationalize, well, they're going to be a little inflamed, but they'll live, for a few more years. We really are heartless sometimes. The emergency responders, I'm curious to see what the deal is with them. Are they all really going to take an mRNA vaccine? They're smart people. They're medically trained. I think they'll try to avoid it if they can, especially if they've been recently exposed. That's actually one of the things that we don't know either, is that the tests of the mRNA vaccines, the ones that are getting emergency use approvals here in the next couple of weeks, is that there's not really any data on how those work with people who have already been infected. So the data is mainly on people who haven't been infected, and there was some unknowns, so they got a little bit of data. People who were infected and they didn't know they were infected, through the antibody tests. But what if 90 days from now, we find out that the mRNA vaccines really were a stopgap, and they're not going to be the real vaccine that 300 million people in the United States and 6 billion, 7 billion people around the world get? Well, that means that the more traditional vaccines that are coming online in the summer and in the second half of next year are the ones that we end up going with. Well, that pushes the pandemic economic impact off into the end of next year. I actually think that's what's going to happen. I think that mRNA is not going to be as successful and widespread use as they're trying to make you think. There's a lot of people out there like me who can read if you can read, go read what the side effects are, and you're going to realize I could wait 6 more months to get a better vaccine. I think a lot of people are going to do that. That means the economy is not in a V-shaped recovery. All the data tells us that. And all these boomers who are going to pull back on their spending short term. I started doing the covered call on Tuesday because I can see what's about to happen. Man, I'm early a lot of times, and you know that by now. But what I tell you is going to happen in the next few years has always happened. Why? I just listen to real smart people, right? I just climb up on somebody else's shoulders. Just like people copied me in high school, my math and my science or whatever. I'm smart enough to go and copy the smartest people in the room. And the smartest people in the room are saying what I'm telling you. So are the experts not experts anymore? I know that it's in fashion to think that. But people who devote their lives to things usually end up being pretty on the money, or at least in the ballpark. And you have your ideologically driven people, and you have your people who aren't that good, who just talk a good game. There's a lot of that, right? A lot of people who learn the lingo of a business or a science or something like that, and they talk a good game, but in reality, they don't know what the hell they're talking about. Stephen Moore, the pretend economist, has been with the Wall Street Journal forever. He's one of those guys. He doesn't know what the hell he's talking about. He just toes a party line. He gets paid for it. He's a mouthpiece. He's bought and paid for. And I've told you that I lean libertarian. This whole capture thing of parties and ideologies, though, I hate. I think being a libertarian is the smart way to go, but it doesn't mean the government doesn't have a role. It doesn't mean the government ruins everything. It means a smart government with smart spending, makes sense. Bad government with dumb spending doesn't make sense. Well, okay, we are the ones that vote the governments in. So let's figure out what we need to do to bring down the debt, right? What do we need to do to bring in the debt so that we don't destroy the dollar, which will cause a financial crisis? All these things are intertwined. They're all connected. And with the exception of the Georgia elections, there's nothing you can do about it right now. No more elections for 2 years and then another one in 4 years. What you can do as an investor is understand what the heck is going on. And there are key charts that we have to watch, and the dollar is one of them. It heads down into this area, you should be very concerned. And if it goes down in here, you should be battening down the hatches. And if it drifts up, that means we get a small correction in the short term because the traders will go nuts. But then you want to buy that correction because this is the Goldilocks zone. So when, there's just so many correlations, but look how long it takes for certain things to happen. It takes a year or two. 6 months, usually the fastest, which is basically what just happened, right? April to December, 6 months to go from one end of the Goldilocks zone to the other end of the Goldilocks zone. So if a jitterbug's up here, we'll get a little correction, maybe, anywhere from 15 to 35%, depending on what the economy is doing, whether or not we get fiscal stimulus, what happens in Georgia, a lot of unknowns. But these are known unknowns. They're not black swans. They're not things that we can't monitor. And that's why I've told you that if the S&P 500 gets around 3,000 again, which I'm 99% sure that it will, we start buying certain things. And that's enough of a correlated correction that we can become buyers. And it doesn't mean buy everything. It means buy our favorites on the barbell. You start scaling in. And if the momentum is down real heavy, you scale in slower. And if there's not a lot of momentum, right? If these charts are starting to break back the other direction, they're leveling out, they're going through that leveling phase, which apparently lasts about 2 days now instead of a month or two, which is what it used to be, then you buy a little faster and bigger. All the folks out there that are still bugging me, I want to buy. Shut up. I'm sick of hearing it. The market's overvalued. I've shown you chart after chart after chart that shows that leverage is high, that it's the small investors that are trading it up. The dollar is in a cross point right now, a cross zone right now, an important juncture. We don't know what a couple of things are that are going to happen. I think they agree on fiscal stimulus. I don't know that. The market will start to tell us whether or not that's going to happen. Today, the market's telling us it's going to happen, but I'm not really sure. I think that's still just the traders. Everything's good news. Everything's a reason to buy. Was listening to an interview with a couple of big shots last night. I'll post it somewhere. And they were talking about the dollar and how cycles work and everything that's within this big secular picture that I described early on today. You have to be super selective right now. Super selective. Because when a correlated correction hits, pretty much everything goes down. Some things more than others. The important thing is that you're not stuck in something that's not going to go back up. And there's an awful lot of zombie companies out there. Awful lot of zombie companies. A lot of those REITs are zombies. And you can say, well, I'm just interested in the dividend. I'm happy to make my 6 or 7% a year. Well, if the price of the stock is going down over a long period of time, that 6 or 7%, number one, isn't really 6 or 7%. And number two, they'll eventually cut it anyway. And we just saw that. There's a lot of vulnerability to recessions. And the idea that we are recession proof just because all of this fiscal stimulus and all the quantitative easing, it's a misnomer. The debt pressures are heavier today than they were in 2007, and the leverage is almost the same. So when they talk about how the legislation fixed the counterparty risk, that's garbage. It destroys the entire global financial system if the dollar gets crushed, because there isn't an alternative to the dollar. People say that there's no alternative to stocks. That's not true. Right now, there's no alternative to the dollar. And there's a lot of people, positions of power and wealth, who wouldn't mind seeing the dollar get destroyed because it's good for them. They own Bitcoin, they own gold, they own this, they own that. It's not good for most people. Well, it might be good for a few percent of the people, and they're powerful. They got the checkbook to try to do it. Did you know that 2% of the Bitcoin accounts hold 90% of the Bitcoin? Did you know that? That should make you very scared of these Bitcoin rallies. Now, when Bitcoin gets crushed, if you still believe the story then go ahead and buy. But these rallies, with 2% of the Bitcoin, or with 90% of the Bitcoin being held by 2% of the account holders, the purse holders, you got to ask yourself a question. Why is it structured like that? How could something that's supposed to be so egalitarian be 90% owned by 2% of the people? And that's just the accounts. You know, I'm sure it's a smaller percentage of people own those accounts than 2%. Right? So people have multiple accounts. And we know that somewhere between 40 and 60% of the Bitcoin is held by the Chinese, right? So when I tell you to buy a little bit of Bitcoin from your savings money, and I tell you 1 or 2%, but don't put it in these investment accounts and don't substitute Bitcoin for stock, oh, but look how much Bitcoin has gone up. Well, but did you understand why? Do you understand the risk? Or do you just buy a pretty narrative? Oh, well, this is how fiat currency works, and blah, 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 fiat currency, fiat currency, fiat currency. Whatever, man. All the little crypto anarchists out there, they're going to lose. The only way that Bitcoin survives is if it starts getting used for transactions. And it goes from casino chip, which is what it is now, to a currency. But do you think the central banks will allow that? All right, we're going to finish off with one little chart. I'm going to take a look at the gold miners. I want to talk about the gold, because I'm recommending it again. The gold miners, there you go, that's a little prettier. All right, we can even go to there. There you go, that's a little easier to read. All right, so the gold miners got down right to the top of my preferred buy zone, right, which is about 33. What is it today? Is it really up 3% today? Interesting. I haven't watched the news in the last 2 hours, so maybe the world changed because it was down to start today. We came off this rally, came down here. Here's why I'm more bullish on gold stocks than gold. Gold could be trapped in a range that's at the bottom of that range is about $1,600 an ounce to about $2,100 an ounce for a long time. It could bounce around like the dollar within a Goldilocks area. 1,600 to 2,100 is a pretty good price for gold without getting speculatively obnoxious. These gold miners, anywhere in that Goldilocks zone, $1,600 to $2,100 an ounce, are very profitable. You've seen Barrick, you've seen Newmont, you've seen a bunch of them raise their dividends and do buybacks and lower debt. Their shareholder yields are awesome and getting better. And they're very selective about the gold mining projects that they do. And there hasn't been any real big gold discoveries in a decade. Just a few of moderate size. So you take a look at the demand for gold, which Chinese and Indians have tons of demand for gold, plus the central banks, plus the fact that there's some industrial uses now. Apple, biggest owner of gold in America, right? Because there's a little bit of it in every phone. That's why your phones are $1,000, right? Is that really like the only thing that hasn't been deflationary other than food in the last 10 years? iPhones just get more and more expensive. Why? Because the tech keeps getting better and better, and it's an integral part of your life. If somebody told you 20 years ago that you were going to buy a telephone for $1,000, what would you have said to them, right? You would have said you're out of your mind. But these cell phones are more powerful than the computers that sent us to the moon. Way more powerful, actually. not even a little more, like way more. And now with 5G coming and AI coming and the new processors in these phones are better than the laptop computer you had 5 years ago. You can hook these things up to monitors if you want to. I'm pretty sure that's where we're going. Think about the iPad and the other devices that are out there. In any case, they use gold. So the gold miners are facing flat to increasing demand. The demand for gold's never going to go down, right? There's periods where there's government policy that flattens it out. Central banks sell a little bit, actually just adding to supply. But in India, they did some things that flatten demand out short term. Well, then you end up getting pent up demand, and bam, then it comes back. So anything that's designed to flatten demand only works for a while, and then you get pent up demand and you get a pop. So what I'm telling you is that the price of gold is going to be in the $1,600 to $2,100 range for a while, and then it's going to break out. And I've showed you the chart. We're probably going to see $3,000 an ounce gold this decade sometime. I don't know when. So that's roughly a double with gold. The gold stocks, on the other hand, they're paying off debt, they're buying shares, they're paying out dividends, and they have enough mining capacity for about the next 20 to 30 years. And I have no idea what happens to the price of gold versus gold miners in 20 or 30 years. I suspect that the price of gold goes way up and the miners go down because they're slowly going out of business. It'd be a contraction like we're seeing in oil right now. But just like I believe that the price of oil is going to go up again, I think it's going to be too late for a lot of the drillers. Here with gold, it's a little different demand and supply pictures. In the oil market, there's no shortage of supply anymore, given that demand is flat and likely to come down by the end of the decade. Projections on oil are impacted by not only this changing paradigm that I opened up with, but in particular EVs. And all the new projections for EVs, which had been for 5% penetration by 2025, then they went to 10%, and then 15%. Now they're saying 20% for the new cars in 2025 are going to be EVs. I'm telling you something, they're wrong. They're still undershooting. New cars sold in 2025, maybe 2026, might be 1 year off there. They're using 2025. 2026 is actually the key year based on mileage requirements for fleets. I'd say by 2026, we are close to 50% of cars are either EV or hybrid, and overwhelmingly EV. What does that do to oil? See, it's the opposite for gold. There's no demand destruction thesis, idea even for gold, but supply is tightening up. So these gold miners are just going to keep dropping profits to the bottom line, and they can drop in a correlated correction too. And if they do, you should buy them, because the upside for this ETF isn't just 70-ish, it's way higher. If you take a line, very simple curve. I did this before. I'm going to find what I used before. We can do it with this if you want to. I mean, if you want to be an Elliott Waver, go ahead and be an Elliott Waver. Yeah, you can do something like that. It's wrong, but who cares? These companies are going to be dropping so much money to the bottom line because they hold some of the gold that this is going to go up to 70, and eventually it'll spike. You'll see consolidation again. I mean, these lines don't exist yet, where it can go. I believe Newmont Mining is going to go to over $200 a share. I think Barrick Gold's going to get to 100-ish. A handful of the juniors, not many. That's why we talk about, rather than buying the gold miner junior ETF, we want to pick those stocks out separately. This has a long way to run. Long way to run. So right now, if you don't own GDX, you should be really nibbling in on every down day and hold a little bit in reserve to scale back in here and down in here, just in case there's a correlated sell-off. It gets it down here again. But I think that's going to be hard because their balance sheets have significantly changed for the better. So I really think this upper 30s, maybe down in here in the upper 20s, right? 33 to 25. In fact, I would even say I'm willing to raise this to there. This confluence aligns, right? This confluence aligns right there, different levels. That's pretty big support. The only thing that gets it down in here is if just everything goes to heck. And we've talked through this a number of times. It hit right at the line that I set up for you. Hit right at it. That's happened a bunch of times where it hits right at a line that I pointed out. And then it rebounds, then it rallies. There's big buying pressure in here. Big buying pressure. You know, I'm gonna go back to 2018, which I think is appropriate to go back to 2018 on everything. It's an important year, right? Because of the two big corrections and the volatility events. If somebody can figure out how to add 2 years right there, I love the 2 year, or even 3 years. I love that. Just how do I add 3 years in there? Teresa, I'm putting you on that. I'd like an answer by 4 o'clock, please. This is really a good area to buy this. And if it gets to here, that's a really good area too. GDX you should be looking at. And remember, Newmont Mining, we'd like to buy in the low 50s because if S&P 500 sells off, that will sell off because it's a member of the S&P 500. And Barrick Gold, I think Barrick Gold is, again, I don't like to talk about a lot of stocks in this call because this is what we cover for subscribers. Barrick Gold's in the buy zone. I mean, it's right in the heart of it. Yeah, could it go down to here? Yeah, for sure. It could go down to 20-ish. But if I think this is going to 80 to 100, which I do, right? It's going to get through 70. Why wouldn't you be nibbling it on it now? All right. So if you've made your first buy right around here, you probably don't have to buy right here yet. You can wait to see if it gets down to here. But in this area somewhere, you should get to a full, 3% position. And if you're stock only, if you're not using ETFs, you get all the way up to 4 or 5%. But if you're an ETF investor, right, if half of your money or a quarter of your money is in ETFs for the asset allocation purposes, your normal size positions are between 1% and 3%. Start small, work your way up, scale in at different technical levels. Don't be like some of these yahoos that buy every time it's a down day, every single day it's a down day. You buy on the important down days when it gets down to here. So if you bought here, right, at 26, and now it's under 24, yeah, you could probably maybe another 1%. Then save your powder for the next 1% in case it gets down here. You've essentially dollar cost averaged in at 26 and 23 something and 20-ish. Get an average price right around 23, 24. Maybe you get lucky and you get an average price a little lower. But again, I don't think there's a lot of risk here anymore. I mean, that was way overdone. Their balance sheet's so much better already. That line right there. I mean, there's not a fib there, but look at what that is. It's a peak, came off it, and coronavirus driven, and went through it pretty easy because they knew that the price of gold is going up. Got a correlated correction. It was an event. This is we're probably roughly at a floor, unless again something really bad happens. All right, no questions and answers today, but have a great weekend. Keep doing your shopping, do your part to buy something nice. I know that I'm talking mostly to people who have a couple bucks, so take advantage of the sales. But I do implore you, look around your communities at the real estate to really think about what's going on. We went to downtown Milwaukee yesterday to get my girlfriend's new cell phone. They had switched carriers from T-Mobile to Verizon because their mother's on the plan and she can't get T-Mobile where she is very well. She has to walk outside to listen to it or to talk on the phone in Phoenix. And so they switched and she got her new phone, the Samsung Galaxy 20 FE, I think it is. And just driving around in what's called the third ward of Milwaukee. And it's a pretty trendy area. It's really nice. It wasn't 20 years ago, but it's become awesome. It's the old area where there were markets in the 50s and 60s and 70s. And then you went through the 80s and 90s and it fell apart. And it's been coming back, turning warehouses into condos, things like that. All over America, you see that, right? Turn the warehouses into condos. Cleveland's doing it. I've seen it in Portland, all over the country, right? And the ground level is shops and restaurants. Well, a year ago, it was hard to find any vacancy down there. There's vacancy or 2 or 3 on every single block now. That's how my daughter got the great deal on her salon. It was a place that I was going to rent for my office because I had a crazy thought that I wanted an office again. It's actually because it was a work-live space, and I could have lived in the back and worked out of the front and actually had a storefront or had an official business address before I moved in with my girlfriend, which has worked out swimmingly. She got the space that I was going to rent, and that's where I built the extra room for her salon. She's super busy. She moved upstairs. She just rented an apartment above her salon. She walks to work through the garage. There's deals out there like that. So if you've been thinking about getting into business, or you know somebody who is, over this winter is a good time to lock up your real estate. And if you can find a building that makes sense, and I'm not necessarily talking residential, maybe a mixed use building, right? Something that has a couple apartments upstairs and a couple shops on the bottom. You know, one of those old style buildings. If you can find some of those in areas that are going to hold up and then rebound, I think that's a great place for you to put some of that bank money. This might be the winter that you should be buying real estate directly in your community if you're willing to be that type of person, right? Because real estate's actually hard to deal with, right? A lot goes with owning real estate directly. But I think that that'll be my next major purchase. I'll manage what I have in my investment portfolios, but my cash flow is going towards real estate and maybe small business investments in other people. I don't know if I can trust. I don't know if I have that in me to trust like that. And that's right, the hurdle you have to get over. But, you know, I would have invested in my daughter, but she didn't need it. And I'll invest in my son if he gets the experience that I've asked him to get. And it's coming. All right. Have a great weekend. I am going off to see my 92-year-old grandmother today, the one that just beat COVID. It's her birthday, 92. I'm going to bring the grandchild over there. We're all going to go sing to her for 15 minutes. All right. Take care.